So good morning. My name's Roy Thompson. I head up MHA Carpenter Box Financial Advisors, and I've got with me today for what I think is Series 7 now of these investment updates. I've got Tom Ledger, who, if you've seen ones before, has spoken with us before. So morning, Tom.
Good morning, Roy.
I think, so we were talking just before we came on there a little bit about the conversation we had a couple of weeks ago, and the conversation we had a couple of weeks ago looked at the time there was perhaps a little bit of inflationary pressure, or markets were concerned about inflation running away a little bit. I guess over the last 2 weeks, that's rescinded a little bit. Markets have perhaps become a little bit more comfortable again. Is that because in the marketplace there's now a view that inflation won't run away with itself, I guess?
Yeah, I think that's absolutely spot on. I think the concern that central banks were going to have to raise interest rates a lot sooner and a lot faster than they were pricing on already has dissipated a little bit. I still think there is a bit of worry there, but definitely the volatility that we saw has subdued a little bit. I think what is a key change here is that the inflationary environment that we're going to be moving into is going to be different from that we've been used to for the past decade. And there are a number of reasons for that. First of all, I think that central banks want a little bit of inflation in the kind of regions, mainly because they want to be able to inflate this huge debt pile that they've accumulated over the past 12 months away, and that will help them, the cost of that reduce over time.
Okay.
So I think that's a key aspect of what we're going to be seeing in the next maybe 5 years compared to the last, is inflation will be higher than it has been, but nothing too scary levels. So we're talking between 2 and 3%, which is much more manageable, and nothing to do with runaway inflation at all.
Okay. And, we're talking about, I read over the course of the last couple of weeks, the cost of importing goods going up significantly. So consumer goods of all types, you get a container from China and the cost of bringing the container here is significantly higher than what it was, 12, 15 months ago. I guess ultimately all consumers are going to pay for that. Is that right?
I think inevitably that the buck will end up stopping with the consumer. I think you only need to look at furniture online or buy, go and try and buy some sizable goods, and there's either the inventories are very low, which again has been a knock-on effect of the pandemic and supply chain disruption, and that sense of the fact that we've also had some fiscal stimulus, which has put more pounds in people's pockets, and the savings rate has exploded to high gone from single digits to double digits. You're going to have probably a case of, when the economies reopen a bit more, a bit of a wall of money coming at those shops, and if they don't have the inventories, naturally that's going to be inflationary. But just to kind of reiterate, we're not kind of concerned that this is going to get ahead of itself, but it is a different environment from what we've been used to investing in, and maybe the mix of investments that we'll look to invest in, particularly in the equity side of things, will look a little bit different.
And so if we've got supply chain issues and low inventory, as you referred to it there, I guess over the next 12 months, once we've opened up, some of those supply chains will reestablish themselves. Do you see at that point prices coming back down? Do you think that inflationary pressure goes away, or do you think it's that sort of 2 or 3% is perhaps more here to stay?
I mean, I think it will depend on the essentially what asset you're talking about. I think some of it will dissipate. I don't think Europe or the UK are going to be starting making electronics here, for example. So I think that will stay in the Far East. But what you might find is slightly more protectionist policies around some manufacturing, either kind of within the UK or within the developed world, and not wanting to lose those to the Far East, which I think they learnt a hard lesson during the pandemic, that maybe they needed some of these goods, and because it was a global problem, not just a regional problem, they weren't able to get them, or at least weren't able to get them for a fair price. And I think that might have a knock-on effect in the next 5 years or so. But having said that, there are still key goods which will be made in Asia, where they have the technology, and I think that's our other theme for the next kind of 18 to 24 months, is maybe more of a shift and higher weighting our equities towards that Asian region.
So what you were saying is UK government, as an example, might seek to manufacture more goods And where they do that, those goods will be more expensive because manufacturing in the UK is going to be more expensive than if you just simply import it from China or something of that nature. And I guess the other side of what you're saying there is that, still there will be electronics, there will be various elements of goods that we might purchase that we would still seek to purchase from the Far East. So you're intimating as well that, looking forward, you might see the Far East or Asia as, a good hunting ground for equity investment. Is that right?
Yeah, that's absolutely spot on. So I think there are a few reasons why. The first really is that they've got their economy almost back to pre-pandemic levels already. So they're kind of first in, first out. They were in a much better position to actually deal with the pandemic. In fact, we're coming up to the kind of the year of when lockdowns started to begin in the Western world. And I saw a chart that someone popped up. It was 12 months old, and it was all color-coded of which countries are best to deal with the pandemic and which ones aren't. And, they all thought the US, the UK and Europe would be the better ones. And it was all Asia and those Asian continent, which would do worse. And actually, the complete reverse was true. It's the fact that they were able to deal with it much better. Their economies have bounced back. They've not had to deploy anywhere near the size of monetary or fiscal tools which the Western world has. And therefore, from a kind of stability point of view, we think those economies are much better positioned for the future. There's obviously the long-term trend of China and Asia really moving away from the manufacturing hub of the world to a more service-led economy. That generally means that it will have more stable returns, more stable growth, if a little bit lower, but maybe more predictable. And again, we just think that's a good backdrop to maybe start shifting a bit more allocation towards that area. I think the last thing to note is the inclusion of the Asian weight within global equity indices. And again, there's lots of institutional investors out there where these indices are a really good rule of thumb of what we should be investing in and what regions we should have. Having that institutional money in the region will really, again, add more stability to it, more predictability to the returns, and therefore for the likes of ourselves, we're more comfortable in having a larger weight than we have done historically.
Yeah. So I guess it's what you're talking about there is the Asian economy is perhaps maturing, and becoming more established, and the predictability, of course, becomes even more attractive because you know where you stand with things. Tom, that's been really useful once again. So Tom Ledger of LGT Vestra, thanks very much for your time. Really appreciate you taking the time out this morning. Thanks very much.
Thanks, Roy.